Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Friday, September 29th. And joining me as always is Dr. Orphe Divounguy, PhD economist. Dr. O, it's great to be back with you. It feels like it's been a while, but I guess it hasn't been that long. I want to talk to you about the Fed and what's going on with regard to the progress that they're making on curbing inflation. We are like within hours of the release of the report of the PCE, the personal consumption expenditures charting that the Federal Reserve likes so much. First of all, let me ask you this: why is that the Fed's preferred temperature gauge for what's going on in the economy here in the United States? Why is it the PCE that they like so well?
Yeah, the PCE takes into account how consumers adjust their behavior with respect to price changes. And so that's, and at the same time, it has to be core because core basically excludes the volatility that you see in energy prices and food.
Yep.
And so that's why. Now, let me just say something. In the last month, what we've seen is we've seen the U.S. consumer, we've seen core inflation continue to tick down.
Right.
Tick down closer to the 3-month annualized rate is about 2% at this point. It's close to the Fed's target. But headline inflation has remained quite high. Mm-hmm. In fact, it's ticked higher in the last couple of months, like even on a year-over-year basis. Right. And so what are we seeing here? I think what we're seeing is a consumer that is slowing down, a U.S. economy that is cooling. But basically, the increase in headline is all about, and I started with volatility in food and energy. It's all about energy prices. I mean, you'd have to live under a rock not to notice gas prices.
Yeah.
Going back up.
You've got some underlying, recently implemented carbon. I'm not even sure how to explain it without getting it wrong. In the state of Washington, where the price of gasoline now is about $6 a gallon, like across the board, at least on the western side of the state.
That's right. And so you have you basically have a situation where higher energy prices or a headwind, they're likely going to cool the consumer, to slow down the consumer even more. And then when you add to that all of the other factors, right? We have the student loan repayments. We have the fact that yields have gone up, which is basically making getting credit, making difficult for small and medium-sized businesses to borrow and continue to hire workers or even make payroll, let alone hire workers or expand their operations. All of those headwinds are acting to slow down the U.S. economy. And so, we were just chanting about how recession risk was receding. And now it's a big if whether or not all of those headwinds are going to be strong enough to pull the U.S. economy into a recession going forward. Right. In 2024.
Just from the data that came out today, and I'm just pulling this directly from the Wall Street Journal's story on it. Today's data showed year-over-year inflation at 3.9%, still above the Fed's 2% target, though below July's 4.2% reading. Personal income jumped while consumer spending fell, and per the Wall Street Journal, it's a little bit of editorializing, but I guess they're generalizing, both in line with expectations. Okay, just from that standpoint.
This is good news for the Fed, right? So the U.S. economy is cooling, right? It's not. We're not going to have inflation.
All the reasons that you articulated and more. And I think that we're going to see. I think we're going to see student loan defaults starting in October already because people have never paid, maybe don't even know that they have to pay, and I think we're going to see some things like that, in the month ahead, which we would find out about, frankly, in November.
Well, yeah. I mean, I don't know if we're going to see. I don't know if we're going to see defaults because the U.S. government's going to step in and whatever. I think we're probably going to continue to see the U.S. government carry the load, and fiscal deficits continue to increase, which will actually push yields, interest rates higher. And that's going to slow down. That's going to slow down, continue to really squeeze businesses. Like I mentioned higher interest rates are basically crowding out private investment at this point, right? They're causing businesses, small and medium businesses, America's largest employers, to they're making it difficult for some people, some businesses to make payroll, and are going to basically cancel any kind of expansion plans that businesses had. And so we're going to see this labor market continue to moderate. We're going to see the number of excess jobs decrease. We're going to see a kind of a slowdown, continued slowdown in the labor market. Now, the big question, I think, for me is whether or not the headwinds, right, all of them coming at the same time, are going to be strong enough to pull the U.S. economy into a recession. My thought on this, at least when people ask me, okay, do you really think that we're going into a recession? I've said, look, you look at GDP now from Atlanta Fed, it's at 4.9% growth in Q3. You look at Goldman Sachs forecast is at about 3.2% in Q3. So I feel like we have a big buffer, right? We have a big buffer. Growth is going to slow, but we have enough of a buffer for it to slow down and perhaps still avoid a recession. And so, in my opinion, the Fed is done. The Fed does not need to raise interest rates anymore because the U.S. economy is cooling. And at the same time, right, it really doesn't need to hike because inflation's coming down. And basically all of the headline inflation, the increase in headline inflation that we're seeing right now is completely outside of the Fed's control. It's energy prices, right? And there's absolutely nothing they can do. That's in itself a headwind for the consumer, meaning things are cooling. So in my opinion, the Fed is done. It's, fingers crossed, achieved a soft landing for maybe the first time or second time, maybe. And so any more action on the Fed's part here to step on the brakes would be a terrible mistake, in my opinion. Because we are headed towards that soft landing. In fact, the market still anticipates potential cuts in 2024 because it thinks that we may still be going into a recession. I don't think we are. I don't think we are. But that's kind of the general expectation, that the slowdown could lead us into a recession, especially if those headwinds are very strong.
That's fascinating, and I appreciate the commentary. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.